Have you ever heard this phrase? The stock market isn't for me. It's reserved for the rich, the experts, people who have studied finance extensively. Or again, the stock market is too risky. You can lose everything overnight. Back-end index pointing right, if this is you, let me reassure you right now. These preconceived ideas are false. Today, thanks to the ETF, investing in the stock market has become accessible to absolutely everyone. Yes, even if you don't have thousands of euros saved up, even if you've never taken a single economics course. ETFs are simply stock baskets that group several companies into a single share that you can buy. It's almost as if, instead of betting all your money on a single company, you are buying a small part of an entire large market. Back-end index pointing right result. You diversify your investments, you reduce risks, and you benefit from global economic growth. All this with simplicity. In this video, I will take you step by step through a complete and practical guide to understand and use ETFs. We will see together what an ETF really is, why it is a powerful and accessible solution, how you can actually buy it, and above all, what strategies to use to invest intelligently and calmly. And the best part of all this? No need to be a millionaire. No need to watch the stock market all day. No need to be a numbers genius. ETFs are the freedom to invest in a simple, progressive, and effective way, building your financial future without stress and without headaches. So, make yourself comfortable because what you're about to discover today could well change the way you see the stock market, and above all, your relationship with money. Books Understanding the Basics of the Stock Market. Before diving into the world of ETFs, it's essential to understand the basics of the stock market. Because often, what's scary isn't the stock market itself, but the complicated words and financial jargon. So today, we're going to simplify all that. Small blue diamond, what is a stock? A action. It is simply a small share of ownership in a company. Think of Tesla, Apple, or Coca-Cola as a huge pie. By buying a share, you own a small piece of that pie. The more the company grows and makes profits, the higher the value of your stock can go. And sometimes, the company even shares some of its profits with you in the form of dividends. Small blue diamond, what is a bond? A obligation. It's different. There, you don't become the owner, you become lender. You lend your money to a company or a government, and in exchange, they pay you back with interest. Example, you lend 1,000 euros to the French government via bond, and each year you receive a small percentage as a thank you. This is generally less risky than a stock, but also less profitable in the long term. Small blue diamond, what is a stock index? And stock market index. It's like a thermometer that measures the health of a market or a group of companies. The CAC 40, for example, represents the 40 largest French companies listed on the stock exchange. The S&P 500 itself brings together the 500 largest American companies. The NASDAQ, he is very focused on technology companies. These indices are extremely important because they provide a global vision. If the CAC 40 rises, it means that, overall, large French companies are doing well. Small blue diamond, investing versus speculating. There's a huge difference between invest and speculate. Invest is putting your money into solid assets, stocks, bonds, ETFs, etc., with a long-term vision, hoping that it will grow gradually. Speculate is about making quick deals, buying and selling constantly, like in a casino. It may work once or twice, but in the long run, speculation ruins more people than it enriches. Small blue diamond, concrete example. Tesla versus ETF. Let's take a simple example. If you buy Tesla stock, you're betting everything on a single company. If Tesla explodes and doubles in value, great, you make a lot of money. But if Tesla falls, your investment takes a big hit. Now imagine you buy a ETF which includes Tesla, but also Apple, Microsoft, Google, Amazon, and hundreds of other companies. Even if Tesla falls, others can compensate. As a result, your money is much better protected. Small blue diamond, the long-term vision. The stock market isn't a sprint, it's a marathon. It's not about making money in a week, but about building your financial future over 5, 10, or 20 years. A patient investor who lets his ETFs work for him benefits from the global growth. And over time, Small amounts invested regularly can turn into very large sums thanks to the magic of compound interest. Back-end index pointing right, remember the main thing. The stock market is not a game. It's a powerful wealth-building tool, provided it is used with discipline and patience. Bar chart, what exactly is an ETF? Now that we've laid the foundations, it's time to get to the heart of the matter, ETFs. So, what exactly is this somewhat technical word that we hear more and more? ETF, that means exchange-traded fund. In French, it is also called exchange-traded fund, but rest assured, behind this complicated term hides a very simple idea. Back-end index pointing right, imagine you want to invest in the world's largest companies. You could buy one Apple share, one Amazon share, one Google share, one Tesla share, but that would require a lot of money. And most importantly, you'd have to buy dozens, even hundreds of different stocks to be well diversified. Well, one ETF like Agent Basket, which combines all these actions into a single product. Instead of buying each fruit separately at the market, you buy the entire basket directly. The result, with a single purchase, you own a small part of all these companies. Small Blue Diamond, how does it work? An ETF's mission is to follow a stock index. For example, an ETF that tracks the S&P 500 will automatically replicate the performance of the 500 largest U.S. companies. A NASDAQ ETF will track tech giants like Apple, Amazon, Meta, Google, and Microsoft. An ETF MSCI World will literally give you access to over 1,600 companies from 23 different countries with a single purchase. So you don't need to individually choose the best stocks, because the ETF already does all the work for you. It copies an index, and you benefit from its performance. Small Blue Diamond, the advantages of ETFs. Immediate diversification. With just €100, you can indirectly own a fraction of hundreds of companies. No need to put all your eggs in one basket. Very low fees. Unlike expert-managed funds, ETFs don't try to beat the market. They simply follow it. As a result, fees are often 5 to 10 times lower. Accessibility. You can buy an ETF just like you would a stock, directly from your smartphone or computer. You don't need millions to get started. Small Blue Diamond, concrete example. Let's say you invest €100 in an MSCI World ETF. Automatically, your money is spread across hundreds of global companies. A little bit at Apple, a little bit at Microsoft, a little bit at Toyota, a little bit at Nestle, etc. You're no longer betting on just one horse. You have a whole herd running for you. Small Blue Diamond, ETF versus active funds. It is important to understand the difference. An active fund is when a team of managers actively chooses which stocks to buy and sell, hoping to beat the market. It costs a lot of money in fees, and most of the time they don't succeed. An ETF makes passive management, no ego, no risky bets, no untenable promises. It tracks an index, period. And over the long term, this simplicity often crushes the results of active funds. Back-end index pointing right, in summary. An ETF is simple, effective, diverse, and inexpensive. It's the perfect tool for someone who wants to invest intelligently without the hassle. Globe showing Europe, Africa, the different types of ETFs. Now that you know what an ETF is and why it's a powerful tool, it's time to find out why it doesn't exist only one type of ETF, but a multitude. Each ETF has its role, its objective, and can meet a particular need. The advantage is that you can combine multiple ETFs to build a portfolio that's perfectly suited to your profile. Let's take a look at the main types of ETFs. Small Blue Diamond 1. Equity ETFs. These are the best known and most widely used. They allow you to invest in publicly traded companies. But be careful, not all equity ETFs are created equal. Global ETFs, like the MSCI World, which includes more than 1,600 companies from 23 developed countries. With a single ETF, you invest in almost the entire global economy. Regional ETFs, for example, a Europe, Asia, or Latin America ETF. This allows you to bet on a specific geographic area. Sector ETFs. They focus on a single sector, such as technology, energy, health, or luxury. Example, a technology ETF will contain companies like Apple, Microsoft, Nvidia, etc. Back-end index pointing right equity ETFs are ideal for seeking long-term growth, but they can be more volatile. Small blue diamond 2. Bond ETFs. Bonds, as we have seen, are when you lend money to a state or a company. ETF obligations group together hundreds of these loans. Example, a U.S. government bond ETF or European bond ETF. The advantage: it generally yields less than stocks, but it is also less risky and more stable. Investors often use them to balance their portfolios, reduce volatility, and protect themselves in the event of crisis. Small blue diamond 3. Commodity ETFs. You've probably heard of gold as a safe haven. Well, there are some ETFs that directly track the price of certain commodities. Lore, money, oil, or even baskets of agricultural raw materials. These ETFs are often used as protection. Example: if the stock markets fall, gold tends to resist or even rise. Small blue diamond 4. Thematic ETFs. This is the trendy category. Thematic ETFs allow you to invest in ideas or sectors that have strong long-term growth potential. Some examples: technology, artificial intelligence, cloud computing, cybersecurity; ecology, renewable energies, energy transition, water; health, biotechnology, pharmaceutical companies, healthcare. These ETFs are very attractive to investors who want to give meaning to their money, but be careful. They are sometimes riskier because they are concentrated on a single theme. Small blue diamond practical example: a simple wallet. To understand this better, let's take a concrete example. Imagine you want to start investing with a balanced, easy-to-manage portfolio. You could choose 70% in an MSCI World ETF to invest in large global companies, diversified across several countries and sectors. 30% in a European bond ETF to stabilize your portfolio and reduce risks. Back-end index pointing right result. With just 2 ETFs, you already have a solid, diversified, and balanced portfolio suitable for a beginner investor who wants to get started without any hassle. In summary, the ETF actions bring growth. The ETF obligations provide stability. The commodity ETFs provide protection. The thematic ETFs bring potential and a little fun. And the best part is, you can combine them like Lego pieces to build your own custom wallet. Bank where to invest, your choice. Online brokers, Boursorama, Trade Republic, DeGiro, etc. Banks, sometimes more expensive in fees, but familiar interface. Investment apps, very simple, often programmed purchases. Check that it is indeed off-cash ETFs and no CFD. Tip: check brokerage fees of change, Euro left right arrow USD, the presence of scheduled purchases DCA, and the possibility to buy fractions of ETFs. Open file folder. Step 1. Choose the right account type. CTO, ordinary securities account, the simplest and most universal. Access to almost all global ETFs. PEA, France, long-term tax benefits. Favors ETFs eligible. Ex-Amundi MSCI World CW8. Simple rule: if you want it greater freedom, CTO. If you prioritize the taxation FR, look at PEA plus eligible ETFs. Magnifying glass tilted right. Step 2. Find the ETF and check the key information. Search by name, ticker ISIN, XCSBX VWC. Before purchasing, check index followed, S&P 500, MSCI World, etc. Current charges, TR. Distribution, ACC, capitalize versus DST, pays dividends. Replication method, physical or synthetic. Quotation currency and stock exchange, Euronext, etc. PEA eligibility if you use a PEA. Liquidity and spread, buy sell spread. Mini error-proof checklist, correct index, low TR ACC / DIST, chosen account eligibility, currency and spread OK, white heavy check mark. Credit card. Step 3, fund the account. Transfer funds to your broker. If purchasing in foreign currency, anticipate the exchange fees. Receipt. Step 4, place the order. Order types, most useful. At the market, immediate execution at the best available price. Limit, you fix a maximum price purchase, more controlled. especially if the spread is high. Quantity, in units or increasing, if fractions possible. Validity, day or until canceled GTC. Chart increasing illustrated demo, fictitious purchase. Scenario ACTO, MSCI World ETF, VWC, on etc. Limit order. Open the broker's app, search bar, type VWC, ETF sheet. Check MSCI World, ACC, week TR, replication physique. Click buy, chosen limit order. Quantity, 1 part. Limit price, Euro 110.20. If the order book shows 110.10, 110.15 euro. Validity, date confirm. The order is executed if the market reaches 110 euros and 20 cents or less. You then see 1 part VWC portfolio. Scenario B, PEA, eligible ETF, X accept MSCI World CW8. On your PEA account, look for CW8. Check MSCI World, ACC, PEA eligible. Buy market order, tight spread on Euronext. Amount, Euro 300 if the app allows purchase by amount or quantity. 1. If price is almost equal to 120 euros. Confirm the order is executed almost instantly during market hours. Step 5. Set up your DCA, optional but powerful. Activate 1 monthly automatic purchase, e.g. 100 to 200 euro/month. DCA smooths out entry prices and removes the emotional element. Brain Step 6. Smart tracking without spending all day on it. Add the ETF and favorite. Creates a price alert. Consult the reporting, composition, costs, index performance. Remember, you follow a clue. No need to micromanage. Money with wings costs to know and minimize. Brokerage fees in order. ETF ongoing charges. TER collected at source. Invisible on a daily basis. Exchange fees if purchased in foreign currency. Spread. Spread between buyer/seller price. Prefer liquid hours. Puzzle piece example of a 2 bricks portfolio. 70%. ETF MSCI World Global Growth. 30%. ETF Obligations Stability. You can then adjust with age/profile, e.g. 80/20ths if more offensive, 60/40ths if more cautious. Light bulb investment strategies with ETFs. Buying an ETF is good. Knowing how to use it in a real strategy, it's even better. Because in the stock market, the secret is not to make a lucky break, but to build a solid and repeatable method. Let's look at the main approaches together. Small blue diamond 1. One-time purchase, one-time investment. This is the strategy of the I have a large sum available, I'll invest it immediately. Example. You have 10,000 euros set aside and you decide to invest it all at once in an MSCI World ETF. Advantage. Your money starts to work right away. Risk. If the market falls right after, you could get a real scare, even if in the long term you remain a winner. Back-end index pointing right. This strategy requires strong nerves and a long-term vision without panicking at the first drops. Small blue diamond 2. Regular investment, DCA, dollar cost averaging. The DCA consists of investing the same amount every month, regardless of whether the market goes up or down. Example, you invest 200 euro per month in an MSCI World ETF. When the market is high, your 200 euro buys fewer shares. When the market is low, your 200 euro buys more shares. Result, your average purchase price balances out over time. Back-end index pointing right DCA is the preferred strategy for retail investors because it removes stress and emotion. You no longer wonder, is this the right time? You invest regularly and you let time do its work. Small blue diamond 3. Build a balanced portfolio. A single brick, like an MSCI World ETF, may be enough, but many investors prefer to diversify even more by combining several ETFs. A great classic. 80% actions, e.g. MSCI World or S&P 500. 20% obligations, a bond ETF to reduce volatility. Back-end index pointing right, the idea is that stocks provide growth, while bonds provide stability. Example, if stocks fall, bonds partially compensate. Small blue diamond 4. Practical example, monthly investment plan. Let's take a concrete example. You invest €200/Monhan, an MSCI World ETF. Over 20 years, with an average return of 7% per year, your invested capital, €48,000, could exceed €100,000. All this without ever having to time the market, just by remaining consistent. Back-end index pointing right, this example shows the power of compound interest. It is not the starting amount that counts, but the regularity and the time. Small blue diamond 5. Adapt your strategy to your age and risk profile. Every investor is unique. You don't build the same portfolio at age 20 as you do at age 60. Young investor, 20 to 35 years old, more offensive profile. Lots of action, 80 to 100%, because he has time to absorb drops. Intermediate investor, 35 to 50 years old, balance between growth and stability, e.g. 70% stocks/30% bonds. Investor nearing retirement, 50 years and over, more cautious profile, reduction in stocks, increase in bonds, and perhaps a little cash to protect capital. Back-end index pointing right in practice. The longer your horizon, the more risk you can accept. The closer you get to using your money, the more secure you are. Sparkles in summary. If you have starting capital, the one-time investment puts your money to work immediately. If you want to start small, the DCA is perfect for building slowly without stress. Build your portfolio like balance between stocks and bonds, according to your profile. And above all, the key is the patience and regularity. An ETF alone can already change your financial life, but a well-thought-out strategy is what will give you the peace of mind to last over time. Warning: risks and mistakes to avoid with ETFs. Investing in the stock market, even with ETFs that are considered simple and diversified, always carries risks. The biggest danger isn't just the market, it's often yourself and your emotional reactions. Let's look at the classic pitfalls together. Small blue diamond 1. Market risk. The first reality. Yes, ETFs can drop sharply in case of crisis. Example: during the 2008 crisis, the S&P 500 fell by more than 50%. Even diversified, ETFs are not immune. Back-end index pointing right, but be careful. In the long run, markets have always recovered. Anyone who held their ETF after 2008 saw their capital explode a few years later. Small blue diamond 2. Selling too early out of panic. It is mistake number 1. Many novice investors sell as soon as they see minus 10%, minus 20%. They transform a temporary loss in permanent loss. As a result, they miss the rebound that almost always follows a crisis. Back-end index pointing right, golden rule. You haven't lost until you sell. Small blue diamond 3. Poor diversification. Another trap. Putting all your money into a single ETF, often national. Example: invest only in a CAC 40 ETF, France. Risk: if the French economy suffers, your entire portfolio suffers too. Back-end index pointing right solution. Prefer ETFs global, MSCI World, ACWI, or at least spread across several geographical areas. Small blue diamond 4. Listening too much to gurus and promises of quick returns. You'll see videos, posts, and advice everywhere that say, this ETF is going to explode by plus 300%. Put everything into this sector. It's a guaranteed future. Back-end index pointing right, the reality is that no one can predict the future. Even experts make mistakes. The trap is to change strategy every month, chasing the latest fashion, and never building a stable portfolio. 5. Underestimating the importance of patience. Investing in ETFs isn't a sprint, it's a marathon. Anyone who hopes to become rich in 6 months will be disappointed. Whoever invests calmly for 10, 15, 20 years will see the compound interest transform your savings into real assets. Back-end index pointing right, discipline and consistency are worth more than good shots. Sparkles in summary. ETFs fall in crises, but rise over time. Never panic sell. Diversify as much as possible, geographically and by asset class. Don't be fooled by gurus and quick promises. The key: patience plus discipline equals success. Seedling the long-term advantages of ETFs. Many people give up on investing because they think it's not worth it. However, what they underestimate is the magic of compound interest. Small blue diamond 1. The snowball effect, compound interest. Compound interest is simple. Your money works, it generates gains, and these gains start working again. Back-end index pointing right result? A snowball that grows over time, almost by itself. Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't understand it pays it. Small blue diamond 2. Concrete example with an ETF. Let's say you invest €200 per month in a global ETF that yields on average 7% per year, which corresponds to the historical performance of the markets over the long term. At the end of 10 years, you will have invested €24,000, but your capital will be worth approximately €34,500. At the end of 20 years old, you will have invested €48,000, but your capital will be worth approximately €98,000. And at the end of 30 years old, you will have invested €72,000, but your capital will reach approximately €235,000. Back-end index pointing right, no extra effort, just patience. Small blue diamond 3. Comparison with a livret A. Let's take the same example. €200 per month for 20 years. On a livret A with interest at 3%. And again, this rate is variable. Your final capital would be approximately €65,000. With an ETF at 7%, it climbs to almost €100,000. Difference, €35,000 more, only because you let your money work in the right place. Small blue diamond 4. Inspiring testimonies. Sarah, 28, started investing €150 per month in a simple MSCI World ETF. She knows nothing about finance, but after 5 years, she's already seen her portfolio exceed €10,000. What surprises her most? She barely had to do anything. Kareem, 45, regrets not having started earlier. But by investing €500 per month for 10 years, he already has more than €80,000 saved. For him, it's a financial security that no bank book would have offered him. Sparkles morale. ETFs are not a gamble. They are not a lottery ticket. They are a long-term wealth-building tool. Back-end index pointing right, if you give them time, they turn small, regular sums into large, life-changing sums that we saw together in this guide. Back-end index pointing right ETFs are not a complicated product reserved for the rich or experts. Back-end index pointing right, it's a tool simple, accessible, and powerful to invest in the stock market. Back-end index pointing right, it allows you to take advantage of global growth, diversify your money, and above all build a solid future thanks to compound interest. You don't have to be rich to start. But remember this phrase. Sparkles, you don't have to be rich to start, but you have to start to get rich. Every little step counts. €50, €100, €200 a month, it doesn't matter. What matters is start now and to last. It's like planting a seed. The sooner you plant, the sooner you harvest. So, if this video helped you see things more clearly, I invite you to YW subscribe to the channel so you don't miss the next videos on investing. YW share this video with a friend, brother, sister who still believes that the stock market is too complicated. You could literally change their future. YW and above all, take action today. Open your account. Choose your first ETF, even with a small amount. Because financial freedom doesn't just happen. It starts with a small step here and now. Sparkles, and remember, in 10, 15, or 20 years, you will thank the version of yourself today for having dared to make this choice.